Billionaire warns of imminent recession and maybe a depression.
Yeah, look, I think there very well could be a recession, or even worse. I really think the one thing that I do have experience in, and I will tell you sadly, that our companies, when we sit on a lot of boards. I don't, but I have delegates on those boards, and some are good, some are fine. But when you get to understand what these boards do, the system is needing fixing. There really are. There's no accountability in corporate America. You have some very fine companies, there's some very fine CEOs, but far too many that are not up to the task that I think is going to be necessitated. So I have that experience, I guess. And then I tell you this, I have kept, and I think we would have done a lot better, but I have kept everything hedged for the last few years. And I think now that we do have we have a strong hedge on against the long positions that we try to be activists in and get that edge. So that's the way I look at it. But I am negative, as you can hear. Short term, I don't even predict. I just.
But I mean, you said it though. You know, you have been predisposed to be negative for the last few years in the market. You've taken that view. You had once talked about, you know, your worries that high yield would blow up at some point. Do you share those worries today, or have you moved past, and inflation now is the primary worry that you have, and all of the implications, negative for sure, that come with that? What's the one area of the market you're most concerned about, if there is one today?
Well, we have a very large position on shorting the malls through the CMBX through a derivative. And that whole market is a huge market. I think it's got a lot of the market itself, I think, is manipulated to some extent. And you're going to be hearing from us on that in that area. But that is an area that I think has problems, and certainly in the B and C malls and in other real estate. I mean, you can't ignore the fact that, and I don't know if this is a change that will continue, but you don't have people going to offices all the time anymore, obviously. And I think that is going to militate against the real estate area, perhaps. But, I mean, there's a lot of different areas that we go into. We just find companies that we feel are undervalued. Like, for instance, now we're in a fight for SWX. It's a utility.
So if you haven't watched this video that I did last week or the week before, Housing Bubble to Burst, I'll put a link in the description below. I highly recommend it, especially if you own a house, if you've got investment properties, if you've got any debt, watch this video. And coming in from the Financial Times, interest rate rise threatens Australia's booming housing market. And coming in from Market Watch, Australia's Commonwealth Bank, markets are pricing in a housing crunch. Australia's biggest mortgage lender is warning that if financial markets are right, that the Reserve Bank of Australia is set to raise official interest rates to around 2.5% over the next 15 months, it will push the cost of servicing a home loan to record levels. Record levels, folks. Gareth Aird, head of Australian economics at Commonwealth Bank of Australia, doesn't believe it will come to that, noting that the RBA says it's planning to raise the official cash rate only to a peak of 1.25%, having commenced raising interest rates in June this year. He says it is possible, however, that the RBA takes policy into contractionary territory, either intentionally to put downward pressure on inflation or inadvertently if the RBA's assessment of the neutral is higher than ours, Mr. Aird said. CBA research indicates that a cash rate of 2.5% would be deeply contractionary and would result in mortgage payments as a share of household disposable income rising to a record high, he said. While CBA is forecasting the worst will be avoided, financial markets are betting that the RBA will take the cash rate to 2.5% by June next year, from a record low of 0.1% now, as consumer prices threatens to rise at a pace not seen since the 1980s. Worse still, the financial markets have the cash rate going to a peak of 3% over the next 2 years. RBA Governor Philip Lowe recently abandoned his earlier guidance that a rise in interest rates could be held back until 2024. He now says an interest rate rise this year is plausible. There has been a strong shift among economists toward the idea the RBA will raise interest rates mid-year if the next set of inflation and wage data show consumer prices have jumped. Mr. Aird said that the Australian government's budget for the year to June 30, 2023 on Tuesday will help determine how soon and by how far the RBA raises interest rates. If fiscal settings remain too loose, the likelihood is that the RBA will need to work harder over time to contain inflation, he said. Looser fiscal policy than we currently anticipate increases the probability that the RBA takes the cash rate to a contractionary setting, Mr. Aird said. And coming in from Australian broker, the NAB, National Australia Bank, predicts 32% jump in home loan repayments. The National Australia Bank, or NAB, has warned mortgage holders that their loan repayments could climb by a third, or an average of $721 during the next 18 months. A surge home loan pain would also see Australian borrowers experiencing the tightest budget pressures in a decade. NAB has forecasted mortgage rates to increase by 2.25% percentage points by September 2023, which would see an average Australian household with a $600,000 home loan owe their bank another $700 a month. Tapper Strickland, NAB's Director of Economics, said interest payments as a share of household income would rise to the highest level since September 2012, with interest payments across all borrowers predicted to increase from the current 4.4% of household income to 7.9%. This would see mortgage repayments as a proportion of take-home pay climb above the post-global financial crisis average of 7% and well above the pre-COF level of 5.7%. While it is clear that the household sector will be able to service a higher mortgage rate, a rise in interest payments relative to income of 3.5 percentage points will have to be financed by a reduction in saving and or lower consumption than otherwise, unless the economy remains very strong and wages growth accelerates considerably, Strickland told Daily Mail Australia. CoreLogic data showed that Australia's median property price was at $718,146 in January, following a 22.4% annual increase, which was the fastest pace in 32 years. Home prices in capital cities and regional areas are also growing at 10 times the level of wages. Factoring in a 20% deposit, a borrower paying off a typical Australian home would need to pay the bank $574,517. An owner-occupier with this kind of mortgage with a still low 2.39% variable rate would have monthly repayments of $2,238. Should variable rates rise to 4.64%, as predicted, monthly repayments on a mid-price Australian home would grow by $721 to $2,959, marking a 32% increase in just 18 months. Wages in 2021, however, only saw a 2.3% increase, despite the ban on skilled migrants from moving to Australia until December, with pay level growth stuck below the long-term average of 3% since mid-2013. Wages in the private sector grew by 2.4%, compared with 2.1% for public sector employees, according to the ABS, and I emphasise the BS in ABS, for the December quarter. Sarah Hunter, KPMG senior economist, said the latest wages growth data was still below the RBA's preferred level before it raised rates. Wages are also well below the 3.5% inflation rate. At the moment, the average worker is experiencing declining real wages, Hunter told the Daily Mail Australia. Although markets expect tightening to begin imminently, momentum in wage setting and price inflation means we expect the RBA to wait until the second half of the year, August or possibly later in the fourth quarter, before pulling the trigger. The Reserve Bank of Australia cut the cash rate to a record low of 0.1% in November 2020 following the national lockdowns. And RBA Governor Philip Lowe last year repeatedly said it would stay there until 2024 at the earliest. But NAB is predicting rates will hit 0.5% by the end of 2022 and 0.75% by the March quarter of 2023. even with rates at low levels. An average full-time earner on $90,329 salary with a $574,517 loan already has a debt-to-income ratio of 6.4. This is already considered to be at dangerous levels by APRA, where a borrower would struggle to pay their mortgage and bills. Since November, APRA has required the banks to model a borrower's ability to cope with a 3 percentage point increase in mortgage rates, up from 2.5% points previously, Daily Mail Australia reported. So here we've got a full 1% in rate rises over the next 2 Federal Reserve meetings is now the market's base case, with futures giving it a 63.8% probability. So that's 2 50 basis point moves for the Fed in their next couple of meetings. And George Gemin asks the question here, at what point does housing market break? And this is in the US, and we're seeing right across the world central banks raising rates now. But here in Australia, we have seen banks increase their fixed rates. 6 months ago, you could have got a 4 and a 5 year fixed rate at under 2%, so 1.89, 1.99%. Now you're looking at between 3.5% and over 4% now for a fixed rate. So fixed rates have been rising. You can still get a good variable rate at the moment, but I expect those to begin rising very soon as well. And the cash rate futures implied yield curve is now predicting that the cash rate, the RBA cash rate, will be 2.79% in August next year. So in 18 months, under 18 months, the market thinks we're going to have 2.79% cash rate, which mean we're looking at mortgage rates at around 5%. So I'm with my buddy Tarek here, who said, just for the record, amidst all these projections of higher rates, I don't think we are getting close to 2.7% or anything in that ballpark. Consumer sentiment and the economy will break long before we get there. I do agree, which is why I'm bearish the property market now. In fact, asset classes in general, except for one. And you can see this chart, last 20 years, house prices gone ballistic. It's gone up a lot more than CPI, rents and wages. And actually, if you have a look at a chart that shows mortgage debt growth, it tracks very nicely in line with house prices. So we know that house prices are very much correlated with mortgage debt growth. And here's a chart of Sydney CPI and dwelling values. And once again, as you can see, 20 years ago, that's when housing values really went up. And actually, Sydney, other cities performed better in that first part of the decade. But then Sydney took over post GFC. And I've shared this before. So this is Canadian home prices versus disposable income. Pretty much around the same time as Australia. 2000, and we see mortgage debt skyrocket. We see home prices skyrocket. And interest rates falling, increasing people's borrowing capacity. So this was a pretty cool chart that I found. And if you bought a house in Australia when you were 30 years old and work out how much did you make in real terms, if you belong to different generations, and as we say in Australia, crap loads, or others use another word that starts with S and rhymes with pit. But really, the economics in the last 20 years in particular has been about creating more credit, cheaper interest rates, as I said, to boost the wealth effect. We heard Bernanke talk about the wealth effect. We hear a lot of Keynesians talk about the wealth effect. And it's why Keynes himself said not 1 in a million could see how falling interest rates were overthrowing the capitalist order. That's what Keynes himself said. And that's been our economic model, especially the last 20 years. Because we stopped producing things, we stopped saving and investing and producing things and having sound economics. Instead, we just went, you know what, let's just create more debt throw it at assets. Assets rise, we feel wealthier, so then we'll borrow against those rising assets. So the debt bubble just keeps increasing. It's like a Ponzi scheme. And we're getting to the end of that Ponzi scheme. So I've shared this chart before. If the RBA does raise the cash rate, look right down the bottom, folks. 2.5%. Then we're looking at 64% of people's income going towards mortgage repayments. And this is where the NAB and CBA are talking about, debt repayments being the highest on record. If we go to 3%, and I'm with my buddy Tarek, I don't think we're going to get there. 71%. Mate, it's game over. In fact, 2.5%, it's game over. 2%, that's 57% of people's disposable income going to repayments. And on the other hand, we've got huge amounts of inflation causing prices to rise. We've got energy costs rising. So people's disposable income's being eaten away right across the economy. And so I guess the question is, at what point do we start seeing asset prices start tumbling? Now, we're already seeing consumer confidence falling. Inflation, CPI is starting to bite. And this is the lowest our consumer confidence has been. If you take out the initial March 2020, that quarter during the cerveza sickness, when we locked down the economy, you take that out, this is the lowest our consumer confidence has been in a very, very long time. And we haven't seen interest rates rise yet. We haven't seen the pain yet. And so I've talked about this on this channel for a long time, that I see CPI rising for goods and services, but I see asset prices deflating because interest rates are going to rise. And that is going to reduce prices and the value of assets, especially assets that are being linked and connected with a lot of debt, whether it's mortgage debt, margin loan debt, whatever. We're going to see asset prices fall. Just like in 1973, 74, I've said it over and over again, asset prices tumbled. Well, the stock market tumbled 50% in nominal terms, while we had CPI at 12.5%. And I see something similar, and I still stand by that. I think we're going to see high energy costs. We're going to see high costs of goods and services, less production, less stuff out there. Yep, people are going to tighten their belts. So the demand is going to decrease, but I believe supply is going to decrease even further, which means prices still continue to rise. And governments are still running huge deficits. So we still have loose policy, even as interest rates rise. So it's going to be very interesting. So where does one invest? Well, you guys know where I invest. I'm in the commodity sector. I'm in the energy sector. I'm in the precious metals sector. I'm in the agriculture sector. I'm in the real goods and services sector. That's what I buy real assets. I want real assets that we cannot survive without. And right here we look at the energy sector. Estimated free cash flow in the energy sector, record highs. And I've shared in previous videos about my investments right across the energy sector, from oil to coal, uranium, to rebuildables. Yes, I have investments in rebuildables, and you guys know what I think about all that. But I have investments in that sector. And then I have investments in metals that go into that sector. I have precious metals. I have agriculture. So what do you guys think? How are you guys playing this? Do you see a recession, or even worse, a depression? Do you see an economic collapse? Do you see asset prices crumbling? Or do you think it's boom times ahead. Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it. Take care, guys, and I'll see you all again on another episode of Finance Uncut.